I've been having this gray hair for quite a long time. So how many more has been added, I think probably my friends from Mumbai will be able to tell. But otherwise, it's always been like that.
Has it been the most challenging year of your tenure, or would you say the COVID year 2020 was more challenging?
No, you know, every challenge in a particular context becomes, it looks more challenging than the previous one. I mean, there were so many situations when I was a part of the government when we dealt with a lot of a lot of challenges. When I came to RBI in December 2018, the entire 2019, the primary focus, not just one of the areas where we concentrated from RBI, but the primary focus in the financial sector was on the NBFC segment.
Correct.
Post IL&FS, liquidity had dried up. There was a considerable undermining of market confidence in the NBFC sector. So in that context, we had to really focus and see that the NBFC sector makes a comeback. So we very intensively focused on the liquidity situation in NBFCs, the bad asset situation in NBFCs, and I think by the end of 2019, we were almost coming to an end of that problem. Right. Then of course the war came in then of course the COVID came in 2020, 21 was Delta wave, and 22 was the war. So it's been one challenge after the other.
Exciting times for you. But, there's been a lot of talk of late of monetary policy failure, the letter that you've written to the government, which none of us have seen.
2021, the inflation will come down. And indeed, it came down. Then 2021, again, in the latter part of 2021, the inflation was gradually going up. In the February MPC, which was very critical, the inflation projection which we had for that financial, for the next financial year, that is from 2021-22, for that financial year, our assessment of the average inflation was that it was going to be 4.5%. The professional forecasters in the market, their forecast ranged between 4.6 to about 5.2%. Whatever it is, inflation was going to be around, in the worst situation, around 5%. We had done our scenario analysis assuming crude at even higher prices at $95 per barrel, $100 per barrel, and we found that the inflation in the worst situation would be around 5%. Now growth was recovering. We wanted a safe landing of the economy during the year 21-22. So in February, contrary to what somebody may say that RBI probably should have increased towards the end of around, let's say, December 21 or February 22. Somebody may say that, but the point is we wanted the economy to have a safe landing, the recovery of the economy, the GDP to be above the pre-pandemic levels. And 21-22 growth was about 1.6% above the pre-pandemic levels of 1920. I'm giving a long answer, but I think
it's a very interesting answer. Please go ahead.
It is necessary. So economy was recovering. We wanted a safe landing for the economy in terms of the growth figures. And I think today, looking back, it gives us great satisfaction that last year the economy recorded, last year meaning 21-22, it was 8.7%. And for the current year, our projection, current year meaning, current year, 22-23, our projection in RBI is 6.8%. The National Statistical Office has projected 7%. We will know after March. So the economy has not only landed safely, the economy has remained resilient, notwithstanding this huge amount of global spillovers which are emanating because of the effect of the war, geopolitics, and the synchronized monetary policy tightening, especially by the US Fed and other advanced economies. Inflation, yes, it did go up to 7% after reaching a peak of 7.8% in April April 22, it has come down. In between, it went up once for 7.4 or so. Now, December figure were released yesterday. It was 5.7. It has come down from 5.8 to 5.7. It's mainly due to softening of food inflation. I do concede that point. But, so therefore, looking at this, now, the law mandates that RBI is supposed to, the RBI Act, the law mandates that RBI has to maintain price stability, basically meaning that maintain the inflation around 4%, keeping in mind the objective of growth. And I think we have kept the objective of growth, which had to be given primacy during pandemic times and thereafter. We have not lost sight of the need to focus on inflation. So therefore, when the war started and, the international prices of commodities, even the food prices went up, prices of edible oil, prices of cereals also went up because of the war in Ukraine. So we did not hesitate to take a decision in an off-cycle meeting last year in May. We were criticized for that. But it was necessary because we didn't want to give a big shock in our June monetary policy. So we split it. We did 40 basis point increase in May for international settlements in Basel. We meet every 2 months. Last weekend I was in Basel. We had a meeting. And there we have very free and frank exchange of views and thoughts and, how we look at each other.
You don't think they should have pressed the trigger earlier, the US Federal Reserve?
Given... No, I would not like to comment on that. I think he is the best judge where he is sitting. From outside, many things, we can assume so many things from outside. We can form our own opinion. But ultimately, it depends on the person who is in the chair. He knows so many inside details and so many other angularities and details and, he is much better positioned to take a decision. So whether he was right or he was wrong, I think it's not proper for me to comment.
Now the whole focus has shifted. I mean, earlier everybody's focus was on when the Fed will stop raising rates and when they will pivot, start cutting rates once again. But now everybody's saying it will be higher for longer. Maybe rates will remain at this elevated level in the US for a very long time. And that is probably material to us as well because we can't function immune of what the US Federal Reserve is doing. So what is your expectation of what might pan out there?
No, I'll talk about the global situation and let me also qualify by saying that I'm not giving any forward guidance or any indication about what the MPC is going to do in the first week of February.
No, I've not asked you that question either. I'm not asked.
No, I'm not saying, you don't take it as a forward guidance for the MPC's decision to be taken. But if the geopolitical conflicts continue in the manner they are at the moment, if the geopolitical situation continues as it is, if there are no new flashpoints, because international geopolitics, if you see, there could be new flashpoints also. So if the current geopolitical crisis continues in the way it is, it could be a situation of high for long with regard to interest rates world over.
Including India.
Not just United States, but I think world over. Now, including India, I will not say, I have said world over.
India is part of the world.
India is part of the world. But having said that, I would also like to add that notwithstanding the geopolitical tensions persisting, every country, every system, human society knows how to adjust to a new situation. So global supply chains have considerably eased out compared to the supply chain bottlenecks which were there. There has been considerable improvement in the global supply chain situation. New alignments are being developed. Countries are, looking at new sources of supply. United States is looking at, there's this whole talk of China plus one. United States is looking at a situation where the semiconductor supply, they develop alternate sources, that is alternate to China. Yeah. So I think countries will find their way of improving the supply situation, in which event there could be a moderation in the, inflation numbers going forward. And also, it all depends on the kind of, the kind of slowdown, to what extent the depth of the slow.
Mr. Das, this is the important question, because I was just reading an article by Joseph Stiglitz, I'm sure you've read the same, where he invokes Maslow, saying
that is prevailing today. A coordinated action between the monetary and fiscal authorities is very important. In the context of India, I am happy to mention that there has been a coordinated action between the monetary and fiscal authorities. The government has reduced the taxes on petrol and diesel twice during this period. Taxes, that is the import duties on import of pulses, on edible oil and several other food items have also been reduced. There were some restrictions put on steel exports. So there have been measures taken by the government with regard to to deal with the supply side issues. In the monetary policy side, we have taken out a lot of liquidity. In fact, I would say that the problem of we are through the Chakravyuh, we are out of the Chakravyuh of liquidity. We have increased the policy rates by 225 basis points. Now, central bank has to do it for two reasons. One is to sober down the demand side. The inflation will remain at the current level or will go up further, and the central bank will do nothing. So inaction on the part of the central bank will fuel further inflation expectations, which in turn will be, self-fulfilling. It will give further push to inflation. So therefore, central bank has a primary role in this. Coming to your point that it will lead to a contractionary situation. It will slow down growth. Some amount of growth slowdown can happen, but there is the policy challenge for each central bank, depending on their domestic context, to keep in mind the requirements of growth. Up to what extent you can push the envelope, up to what extent you can, do it, in the sense that it should not be totally detrimental to the, growth objectives and detrimental to your, employment and your growth situation. I use the word employment because in the United States, mostly it is, they go by the employment numbers. In countries like India, we go by the growth numbers, the GDP numbers.
how much sobering of demand are you expecting, Mr. Das? Because, a new credit cycle for the banking system has just begun. Do you think it will be thwarted or reined in by this kind of moderation in demand? Because I was speaking to a banker this morning who made the point that they're still not seeing that kind of enthusiasm on the part of corporates to take up credit in a large way. It's still retail.
You are right. The credit growth so far has been largely retail in India in this cycle. And, but my sense that I get from our interaction with bankers is that they have started receiving proposals for wholesale credit. And I do believe that given the importance which is being given by the policy authorities to, let us say, to renewables and to several other sectors like renewables, there will be big demand for credit from the, domestic banking sector. And lot of credit was availed by our domestic corporate houses, particularly, in the, during 2020 or 21, from the overseas markets. So they have met their funds requirement by going to overseas markets at that time. Now the focus is turning more towards the domestic segment, to the domestic, meaning our Indian banks, the banks in India, because there the rates have started going up. And they're all pricing further increases, and there is also uncertainty how much of increase US and other countries will do. So wholesale credit, I think there are signs that it is picking up. Given the fact that our economy has held up very well and it remains resilient, I think going forward we should see, more of wholesale credit demand coming up. Investment cycle, the current GDP growth is sustained mostly by mostly by consumption and by investment demand. But investment demand till now has come from government capex. The private capex cycle, I think, is showing some signs of improvement. And going forward, it should pick up further because capacity utilization of the manufacturing sector, our last survey for Q2 showed that capacity utilization for manufacturing sector is around 75%. Even seasonally adjusted capacity utilization was around 75%. Services exports are doing very well. Domestic services sector are doing very well. So I think going forward, we should see some pickup in wholesale credit also.
You mentioned services, which reminds me that I wanted to ask you about, on the point of inflation, do you think there is some stickiness in core services inflation, which is a problem that you need to be very mindful of? Because we speak a lot about imported, please finish your word, drink your water. There's a lot of...
You can make your question slightly longer.
Okay. I'll take a leaf out of your book from your answers. Now, I was saying that there's a lot of focus on imported inflation in discussions on inflation, but I think people speak less about core services inflation. Do you think that could be a fairly significant part of the problem?
You see, core inflation is definitely... Give me a moment.
Of course.
You see, core inflation is certainly an area of concern. We have highlighted in the last monetary policy statement, if you see the minutes of the resolution of the last monetary policy committee meeting, the focus was on core inflation. In my policy statement, I had also devoted considerable amount, focus, I had given focus on core inflation. Core inflation still remains sticky around 6%. The number which came out yesterday, core inflation is about 6.1%. The previous month was about 6%. Although the momentum of core inflation within that seems to have slightly moderated, but the point remains that core inflation remains sticky at 6%. And that is not a very comfortable number to deal with. So therefore, we have to keep, as I said earlier, in my last monetary policy statement, we have to be very vigilant and we have to really keep focus on the core part of the inflation because that is becoming sticky and we have to see, and that is something which has to be dealt with. The supply side measures taken by the government, the easing of supply chain bottlenecks internationally and also within India, I think all these factors will probably have their impact and the monetary policy action taken which we started in May. I think going forward, they should start working in a more visible or pronounced manner so far as core inflation is concerned. But at the moment, we have to continue the focus on core inflation or as I said, the Arjuna's eye has to be maintained on, kept on core inflation.
Back to growth. You spoke about the moderation in demand. Now, if there is a significant sobering of demand in the coming year, plus cost of capital goes up for companies, could we be saddled at the end of this credit cycle with another set of bad assets like we had in the previous round? NPLs go up again over 4 or 5 years.
You see, cost of capital, if you have to see it in real terms. Real terms would be taking into account the inflation. We cannot just go by the nominal number of the interest rate. You have to see it as what is the real interest rate, taking into account net of inflation. Now, with regard to your point on bad assets, we have over the last 3 to 4 years, starting with 2019, particularly in the post, a lot of steps have been taken before that. I'm not trying to say that it all happened now. Number of steps have been taken by the RBI over the years, but especially in the last 3 years, post ILFS and post all those bad asset problem which the banks faced, we have really sort of tightened our supervision. And the kind of things which we are now looking at in the banks, in the NBFC sector, we didn't do it earlier. We have developed early warning signals. We are looking into the business models of banks. Our information system get from the banks that has been further improved. So we get, almost on a real-time basis. Real-time is, I think, will be a bit of exaggeration. I would say that it's an ongoing process now. The supervision by RBI is an ongoing process where we keep on monitoring not only the numbers, but we, within each bank, within each NBFC, particularly the bigger ones, we look at where the credit growth is happening, what is the build-up in bad assets, if any. Like, for example, retail credit has picked up over the last 1 year. We are always mindful of, within retail credit, what is the stress level? What is the bad asset level? Bad asset level is 91 days or more of, overdues. But within that, we have in our system, we have overdues which are more than 30 days, overdues of more than 60 days. So we monitor that. So the moment we see that in a particular sector or in a particular bank, or, there is some stress is developing, we immediately sort of become alert, and we have internal red flagging systems, we have early warning signals, and we immediately flag it to the banks concerned.
Is it at a micro level?
Sorry?
Is it at a bank level also?
It is at a bank level.
Individual bank level?
It is at individual bank level. It is also at the level of individual large NBFCs.
Okay.
And so we immediately flag the issue. And that is why we have also advised the banks to really make their risk management committees, their audit committees more functional, more robust. We have issued some guidelines for that. And we just convey it to the banks and request them that you examine it, go back, discuss in your board, take a view what is happening, take whatever mitigation measures are required, please do take it and inform us. So therefore, I think there is a great awareness even among the banks. The banks themselves, I am happy to point out that and the banks themselves today are much more concerned about the problem of rising bad assets.
Yeah.
So I think overall the whole, the whole banking culture, if I can say, that the prudence, a culture of prudence has developed in the Indian banking sector over the last few years.
Going by the metrics that you just spoke about, would something like the ICICI Bank Videocon case have propped up as a red flag alert with the RBI? That too many loans are going to one group, not backed by enough kind of assets. Would it have showed up?
No, I would not, let me say that I don't want to comment on a specific case.
But it's a very large case.
It's not proper for me, being the regulator, to comment on a specific case. It's not proper, and I will not comment on any specific
would
case.
Something like
complete.
that?
No, I'll just complete. It's a specific case of that. I'm not commenting on the specific case. But in general terms, I would like to say that RBI is not sitting in the bank monitoring each and every check payment, monitoring each and every loan sanction. It's not our job. It is the bank has got a risk management committee, the bank has a credit sanction committee, the bank has a board of directors, the bank has a senior management, a qualified professional CEO assisted by a lot of senior management. It is their responsibility to do the due diligence. We cannot be looking into the kind of loan appraisal and the due diligence which a bank does in each and every case. That's not our job, and that's not desirable. For God's sake, if RBI or any regulator in any country gets into those areas, you are you will kill the credit, it will sort of be highly detrimental to the credit effect. So therefore, individual cases of failure, they could be due to business failure also. There are, situations where there could be business failure also. But individual cases of failure, it's not possible for the Reserve Bank, because we cannot put ourselves into the role of into the chair of the credit sanction committee of the bank. So we monitor the overall numbers, we monitor the sectors. We don't really look at individual cases of, how the loan was sanctioned. But yes, if a large portfolio, there is slippage, that overdues are building up, if it's a large loan, we would certainly flag it to the bank that, need to focus on these kind of large portfolios.
I was hardly blaming you, sir. You seem to have taken it personally. I was asking whether it would show up in your searches. I was not blaming the RBI for the ICICI Bank video one case at all.
No, not that way. I think it needs to be examined. Did I sound as if I was trying to? No, I didn't see it that way. I didn't see it that way. I didn't see it that way at all. What I'm saying is that our systems, you asked whether the system that we have, whether it will be able to focus on, pick up a case like the one you mentioned. In that context, I said that we cannot become the appraisal authority in a bank. Sure. To that extent, I just clarified the RBI's role. We look at individual portfolios, and if there is a very large loan and if it is showing signs of stress, naturally it will be noticed. And before us, it is actually the first line of defense. In any financial system, the first line of defense has to be the bank management itself.
Sure. Let me rephrase the question in a different way on the same subject. There's a report which came out last week, authored by Sucheta Dalal, where she points out that in the IDBI Bank case, almost all the loans which were made to a group called the Siva Group came from public sector banks. Do you think, or would you agree that public sector banks are most susceptible to such kind of dubious loan practices which end up in scams and therefore leading to large NPAs? Or is it an unfair assessment?
No, I don't want to comment on individual cases of, what happened in this case, that case. I would not like to comment on that case. The improvement in the banking sector over the last few years is both in the public and private sector. So it will not be fair to just pick up the public sector and say that, this has happened in the public sector. Today, the functioning into the prudent management, all the improvement in terms of governance is visible both in public and private sector banks. So it will not be correct to generalize and put all the public sector banks in one, bracket them and put them into one basket. There might have been individual instances in individual banks. It will not be correct to generalize on that basis.
Okay. My colleagues have a few questions, but before that I want to ask one question on your recent comments on cryptocurrencies. You made a statement that they might be triggering the next financial crisis. It could come from there. Do you think they should be banned?
RBI's position is very clear. It should be banned.
All of them. No activity should be allowed in cryptocurrencies?
The technology needs to be supported. The technology of blockchain needs to be supported because the technology has got so many other applications. Again, it will become, I can see the clock there, so it will become again a large answer. So I will try to paraphrase it as much as possible. You see, why we are saying it is going to be, apart from the commonly known dangers of, money laundering, terror funding, what are the principal concerns that we have? First thing is, what is crypto? Some people call it as an asset, some people call it as a financial product. But you will agree that every asset, every financial product has to have some underlying. In the case of crypto, there is no underlying. And I had said it in some press conference that not even a tulip, alluding to the Dutch tulip mania. There is no underlying. The increase in the market price of crypto, various kinds of crypto which start at a particular price, then it multiplies over, in a matter of few weeks or few months. It is based on a make-believe that this is worth so much or it will go up to such and such level. So anything without any underlying, whose valuation is dependent entirely on make-believe, is nothing but 100% speculation, or to put it very bluntly, it is gambling. Now, in our country, we don't allow gambling. If you want to allow gambling, treat it as a gambling and lay down the rules for gambling. But that's not a financial product. So therefore, crypto masquerading as a financial product or a financial asset is a completely misplaced argument. And the bigger, more macro reason for what we are saying is that you see crypto, so-called crypto assets or cryptocurrencies have the potential, they have the characteristics of becoming a means of exchange. That is, they can become a means of exchange of doing a transaction. And most of it is dollar denominated. So if you allow it to grow, assume a situation where 20% of our transactions in the economy, 20% I'm mentioning an ad hoc number, 20% of the transactions in the economy is taking place through cryptos which are not issued by the central bank. It is issued by private companies which are placed all over the world. The Reserve Bank, being the monetary authority of the country as the central bank, will lose control over the money supply in the economy. We will lose control over 20% of the transactions in our economy. Reserve Bank's ability, the central bank's ability to decide monetary policy, to decide on the liquidity of, the level of liquidity that needs to be maintained, the level of money supply, M3, that has to be maintained in the economy, the Reserve Bank's authority to that extent will get undermined. It will lead to a dollarization of the economy. And please believe me, these are not empty alarm signals or empty, this can happen. 1 year ago in the Reserve Bank, we had said that this whole thing is likely to collapse sooner than later. And if you see the developments over the last 1 year, climaxing in the FTX episode, I think I don't need to add anything more.
Okay. My colleague Saurav Majumdar from Business Today magazine has a question for you, Mr. Das. Saurav?
Yeah. Good evening, Governor. Good evening. I just wanted to say, you spoke your views on crypto, which you just elaborated on just now, very well known. RBI has just rolled out the CBDC. There is some confusion yet about what the CBDC will do and how it will play out. It will be great if you can just throw some light on what the CBDC exactly will entail. Another little question attached to that is, not strictly related to CBDC, but about the digital, the whole digital initiatives of banks. Now, they're hugely, under pressure in terms of the core banking, which we discussed earlier in the course of the discussions. Now, what are the risks you see as the regulator in terms of banks going increasingly digital? And as the regulator, what are you telling them to do? Because digital is a given.
The digital part, the systems have to be very robust. The basic IT systems of banks will have to be very robust. Data privacy is an issue. There has to be adequate safeguards to, I think there are a large number of bankers here. They are much better placed to reply to this question. But let me say that issues of data privacy, issues of robustness of the technology, the IT system itself, the focus has to be on that. And many banks are also actively engaged with many big tech companies. So the challenge to the banks is that it should not lead to a situation where the banks, where the big techs come and sort of start dominating the banks. The banks should take their own decisions. The bank should not be swallowed by the big techs, but the bank should utilize the technology and the service provided by the big techs. And they can develop various kinds of